Hello guys, I will be discussing stop losses and where to set them. Many aim to set stop losses at a place of pain threshold. Others have a set percentage, but there is one way that will be more consistent and make more sense in the long run. To start off, what is a stop loss? A stop loss is an order that is placed with a broker to sell securities or contracts when they reach a specific price. These orders help minimize the loss an investor may incur in a security position. So if you set a stop loss order at 5% below the price at which you purchased the security or contract, your loss will be limited to 5%. Some set losses by the percentage method. This limits the stop loss at a specific percentage. Some use the support method. This is where you determine the most recent support level of the stock and you place the stop just below that level. Some use the moving average method, where you set the stop below the long-term moving average. Keep in mind, there are some risks, such as slippage with tight stops and less liquid underlyings and option chains. Slippage refers to the point when you can't find a buyer at your limit and you end up with a lower price than expected. Now, where to set stops? Protective stops need to be consistent with the trade analysis, not the pain threshold. Identify the price at what point you believe your trade hypothesis to be wrong, and set your stops accordingly. Then size the position based after that calculation. No one wants to fully lose a position they have in the market. That's why it's important to set a floor for your position. You can do this for option contracts and stocks using stop loss orders. Investors and traders may be disciplined enough to set these levels, but have a tough time determining exactly where to place them. Setting them up too far away may result in big losses if the market makes a move in the opposite direction. Setting stops too close and you may get pushed out of the position too quickly. The most common error is setting a stop loss based on pain threshold for a given position and not price level that disproves the original trade premise. This practice also ensures you have a trade thesis and investment hypothesis fully formed prior to entry, something critical to success in the long run. Now onto the psychology of stop losses. Rules for risk management remove the emotion of dealing with losses. As mentioned, a key insight is that the placement of stops should be based not on the pain of the loss, but rather at the level that indicates one's forecast is wrong. An example trade thesis could be, say there's an upcoming earnings report for a known momentum and growth name such as Zoom, and you hold a hypothesis that investors and traders are going to enter the stock in anticipation of this event as the event nears. If you were to enter the stock or a bullish options position in this instance, you should not set a stop loss based on the max loss you can take, but rather what renders this thesis incorrect. Say the stock trades down or flat for a few weeks or a few days, and the interest you expect does not seem to be there, then you should exit. But if your thesis is not proved incorrect yet, the price action means your trade is down more than you can bear on a single position, you either should have changed the strategy you implemented or sized according to your pain threshold. Using this approach, if the market reaches a stop point, it will be consistent with your own beliefs that the trade premise was wrong. This will make you less likely to want to re-enter without fully reevaluating with fresh eyes. Oftentimes, traders get burned being stopped out from pain thresholds and keep entering and getting stopped out when losses add up to far more than the even risk tolerance. And it doesn't matter if the investment thesis is correct or not. The discipline of setting just any stop loss may prevent a single large loss with the trade analysis, but it might not prevent cumulative losses that are even larger. Stop losses are a form of profit capturing and risk management, but they do not guarantee profitability. When used along with an investment or trade strategy, they can be an extremely effective tool. I hope you enjoyed this video on where to set stop losses. Comment below your thoughts, and if you liked this video, make sure to leave a like and subscribe below. Up next, the importance of implied volatility.